So anyway, I just wanted to kind of talk a little bit this morning about and just get your perspective on yesterday's FOMC and the presser.
Yeah. I've got all kinds of notes. Again, I'm just a little out of sorts with the move. God, but the last blog garnered so much. I mean, there's 68 conversation, but they didn't even meet me, so that was good. Then I feel good because it has a lot of very deep discussion going there, so that's good. Okay, I thought the press conference revealed how weak Powell is. Steve Leisman, I thought, asked the question of the day, and he got danced, as I said to Santelli. I said, for me to say that Leisman, and he did. It was a three-part question, and it was really trying to detail out where was the Fed going to get concerned about, when interest rates were deemed to be a little too high, and he was trying to flush out. He wouldn't say yield curve control. So it's almost like, can you hear me? Let me plug it. Wait, hold on.
Perfect.
Let me plug my mic in. I don't have it connected. Is this better if I go to this?
No, we hear you good.
Okay. So, Leisman did ask the question that needed to be asked, and he was way down the queue. But Powell, as Peter Bookfire pointed out, basically, because he cited that too, and I was laughing. I got right back to him because he wrote when he did his write-up, talked about that, and that Leisman's question was the most important question, which I agreed. But he said it's like Powell read a prepared statement, and if that's the case, then it's like the media was told, "Hey, we're not going to discuss yield curve control." Now, I don't know that. That's just a conjecture on my part. So, but it did seem, I got John Goldsberry. I don't know if you know Goldsberry, but he's been.
I don't.
You know?
No.
No. I thought he was very weak. He danced him. He did not want to answer that. And yet it's a very important part of this. Because again, how high, or better phrased, how wide is the yield curve going to go before the Fed gets concerned? And Powell just stayed, he would not answer it, even though that's what Leisman was asking. He wants no part of that discussion. It's, hey, inflation is transitory. If you think that the rate, and they think the rates are going up because the market are buying the nonsense that it's in anticipation of inflation. I don't think it's anticipation of inflation at all. I really don't. I think the market is just pushing the Fed going, okay, you think you can stay here. It's as much financial asset prices going up, and the market's going, okay, you know what, things are good, but I want some higher yield. I'm going to push on the higher yields, and they're getting it on the longer end, and they're going to keep pushing though, because look who's allied again. The Fed's in a war. I keep saying this, the Fed's in a war, they don't realize it. And as I was texting with Santelli this morning, I texted this to him. I said, look, here's the way I see it. Jerome Powell, you're too young, Matt. It's the 60s and early 70s. Jerome Powell comes out and gives body counts while Saigon is being sieged. And because body counts are high enough, they keep maintaining that they're winning the war. They're not winning the war. And there is a war, and it's a guerrilla war. And you now have Ray Dalio aligned against you. You have Buffett, all people talking about the ridiculous investment opportunity in the bond market, all of them. And that's not counting the ones we know well before that, the Druckenmillers et al., who are now just attacking the weakest point and are going to force the Fed into YCC. Now, you're going to, and of course, here's the Fed. They're never ahead. They're always lagging, because every time they got ahead, like when back in 18, when they started raising rates as well as tapering the balance sheet, which was a mistake. And I can tell you, I can claim to be well ahead of them because I wrote it in the blog many times. I was Kelly talking about it. And then Druckenmiller, back in December of 18, before the famous Powell pivot away from it, when he panicked, called it the double shotgun approach, which was a mistake. So now they're daring the headlines. They are so afraid. They are so afraid. And they keep, again, he makes the major mistake. They are a social justice ministry. Don't you, if you can tell me that they're not, I don't know what you're looking at.
That was never more clear than yesterday, I thought.
Yeah, very clear. I mean, he kept coming back to it and coming back to it and coming back to it. And it resonates with a lot of the questions that get asked because not quote unquote financial journalists asking. And then there was a very good question. Mike McKee had him up against the wall. Mike was really pushing on the supplementary leverage ratio. He wanted some answers, and Powell was not answering. He did not deem it, that he had to answer because he has no answer. And the deeper you tie yourself into this social justice game, the worse it is. It's not fair. And that's why the bonds are being sold off, by the way. It's a vote against Fed integrity. I don't say it's a vote against inflation. My stance on the gold market and the precious metals has been that gold goes up not because of inflation. Inflation truly comes, the Fed can be forced to raise rates. Short rates. It's the curve inverting that will crush asset prices. Steepening yield curves, which reflect that the Fed is really losing its credibility or quote unquote is behind the curve, have never been negative for stock markets at all. Not positive currencies, but I offer one caveat because I always believe it's different. And here's the difference when we're seeing this steepening. It's with rates locked at the lower bound of zero. We've never seen this, ever. Because when we had the 30s, you had real deflation. We don't have deflation. So we are in a whole new game here, which we don't really know the outcomes. And that's allowing the trader and investment community to push bonds lower. And, it's like Judd, somebody else asked me yesterday, well, how do you make this? And with the 30, because if you saw, you did. What am I talking about? Your question, why were 10s higher while 30s were getting hit pretty hard?
Yeah.
And my response to you.
And big.
Yeah. What did I say to you? Okay. I'm not putting you on the spot.
I don't remember.
They went after the 30 because the 30 is the most.
Oh, because it's easy. Yeah. Yes.
Right?
Yeah. Because it's the low hanging fruit. So they're selling 30 off because they can.
Exactly. Because then he was a little coy, right? He makes that statement about that there's an announcement coming. And that appeared right, when we were discussing the possibility of some change on the supplementary leverage ratio.
What else? Strange. Yeah.
Coy about that. He said there's an announcement coming. He did not want to lock up. And this is a question I have. What did he want to lock up about? What was he afraid of here? Why did he just say, we're in favor of extending the supplementary, or we're not in favor of it? Now, Zoltan Pozar, who I think is certainly one of the best plumbers, maybe at this time the best, but he's really good. He maintains that the lifting of the repo size from 30 billion to 80 billion is done in an effort to calm the markets when they announce that they're not going to extend the relief on the supplemental leverage ratio. His view on it. And I'm not going to lock up with Zoltan. He's good. But I see more the politics of this. And you better write this down because this is serious. Is Powell afraid of Senator Sherrod Brown and Lizzie Warren, who are opposed to extending relief to the large banks from the regs of the supplementary leverage ratio? If he's afraid of them and moves to curb the relief because it expires March 31st, is this why he did it? Is this, we don't know that. We don't know that. But I'll tell you this: the banks are. Look at the bank stocks today, right?
Mm-hmm.
I'd say pretty good. Or as Larry David would say, pretty good. Here, last night I put out a little note to some people after what the Japanese, the Nikkei paper put out a thing that the Japanese were going to widen their yield curve control targets. The yen immediately bounced. It has since resold off. But I put out a note as soon as I saw that. Let's watch the Japanese bank stocks. Well, let me make sure. Mizuho is up, marginally. But it is, if you put up MFG, you can look at the chart. It's a stock. You'll see, but it's had a nice week. It's already up. Yeah, it's so negligible. It's about 5% on the week, and it's having a. But the one that's Mizuho.
Mizuho.
Yeah, that's MFG. But if you look at MUFG, which is Mitsubishi Financial Group, it's MUFG.
Oh, they're up a lot. They're up 5.5% today.
Yeah, this is a very nice move here because they are the most dominant bank in Japan. But look at what just a little bit widening on an official announcement does. So that's the impact. But I'll tell you what, if you get any sense of yield curve control in the US, the bank stocks would have a big correction. But right now, it's party on. And believe me, it's irritating Lizzie Warren and Sherrod Brown, because then there was a question about, well, would you curtail? I forgot who it was, from either Politico or somebody. Now, Politico asked a really good question. Forgot who asked it. Maybe CNN. Would you curtail bank buybacks and dividends again if you rescinded the supplementary, the relief from the supplementary leverage ratio? Would you then, or if you continued it, would you halt it? I wasn't sure where that question was going, because that's, again, because Lizzie Warren and Sherrod Brown want the banks to hold more capital. But it's hard to ask them, because when you have to hold more capital, that means that they're not going to be able to buy as many treasuries. This is where they're locked in here.
Is that why he didn't want to answer the question yesterday?
Yeah. Now he's speaking today somewhere at 11 o'clock. I'm trying to find out where. So that's the issue here, because if the large banks can't for the last year, since they ran into trouble, they suspended the leverage ratio, which allowed them to buy more treasuries. Well, we know the Treasury is pumping out more and more treasuries because the debt is building. So you need these banks. It's part of the reason that the long end of the curve is going up, because they're anticipating that the banks are going to back off because they can't buy them. They're going to have to hold more capital. Now it's a freebie, basically, kind of like what goes on in Europe. So we're in the throes of this. This is very important. But I point out the Japanese bank stocks, not because we have talked about them. I've talked about how long I've been, and it's nothing to be proud of, because I've been long for way too long, but I've earned so much in dividends over the years. It's now I'm finally making some pretty good money. It's worth watching. There's a lot of things, but I thought the press conference was terrible. Terrible, terrible. After Biden was elected, I wrote a piece that talked about that
Mhm.
Powell should resign with dignity because, this is a very important spot and he should offer his resignation to Biden saying, look, I believe that the president should choose his own Fed chair. I'm in the running if you so choose, but I would leave it up to you. That's the way I would do it. Could have held your dignity and escape from this mess. This is a giant mess. I don't know how you get out of this. Now, I know how Paul Volcker would get out of this if he senses inflation coming, boom. But what did Powell tell us yesterday? The Fed knows that any rise in inflation is transitory, right?
Yep.
It's only excuse me, it's only a result of the deflationary impact from the previous 12 months of that data dropping out. So of course you're going to, as oil price, we went to, $20 oil, $10, forget the negative, that was more, as my friend Mike Lies would say, that was a financial deal because you just ran out of space, and then they just put it at sea. And, everybody was renting ships. So when they found storage capacity.
Mhm.
So according to the Fed, inflation will jump only because the data changes on the way that they measure. So it's all transitory. Don't worry about it. But the market is going, okay, Jerome, I'm a little more worried about this than you are.
How does this end, Ira? I mean, we've talked about what the market will look like when or if the Fed announces YCC. No answer for the SLR question yesterday, and maybe today when he speaks, he'll make some sort of a hint or an announcement. But how does this end? Does the dollar still? Will the dollar still bid hard? Will gold still? Well, gold will still hold its strength because it does appear that the Fed is losing control or credibility. Does the low-hanging fruit, the 30 years, still continue to sell off until they announce yield curve control? And even then, even after they announce yield curve control, will that be enough to stave off the rise in the 30-year?
Well, listen, if you went to yield curve control, then the sellers don't have a free run. Now they have a free run.
Yeah.
And I was on with Judd when I was in Chicago packing. The market takes its free run, and that's what they've been doing. So, okay. What can I say to you? And the market is smart. And every time that Buffett or somebody of great money under management comes out and starts bashing the bond market, how are you going to stop them? Again, I still think the 10-year, as I said, to me, the 30-year actually offers more value. And that's why when you asked me about the 10 yesterday, I thought they were, well, okay, if we get yield curve control, it may be, and you wrote back to me, within the belly,
Yeah,
rather than at the end. So I'm going to take my run at the end. And right now, I would argue that at least the 30-year, its real yield is probably zero, maybe even a little positive.
wow.
But nobody cares. The only ones who care are, of course, Japanese investors who are looking for nominal values still. But that's going to change too, and I still, until I'm convinced. Now I know we're in a very the battlefield has changed. We're in a very new environment because again, low interest rates are pegged at the floor. Inflation is high. We don't have deflation. So the last time we had interest rates pegged to a floor, not by the Fed itself, because there was deflation. It's kind of like in Japan.
Mhm.
There was deflation. Sorry, I got a better cup.
Yeah, that's all right.
Oh, we don't have any New Yorkers on here because they know everything already. So, oh, wait, I shouldn't say that. One of my favorites is Penn, but she must not be a real New Yorker.
Yeah, Penn's not around today.
So this is just setting up, and the market did exactly what it should have did. Now I'm a little pissed at myself because I was going to sell I have orders in all night to sell the 5-year. I had the June at 124.02, 2.25. The high was 1.5. When I woke up this morning, I go, had I been awake, I would have hit it. Those were
We hit them.
my overnight levels, thinking that, because I saw those yesterday. I said, okay, let's see if they come back for them. And to me, selling the 5s was the best play of all because that made sense. Okay, because we're going to attack you everywhere. Because if I'm doing any type of trade as the long end gets cracked, I'm not ready yet, but I will buy some 30s and sell some 5s somewhere in there. Now, I run the risk, of course, if they come out and do yield curve control out to the 10 years. But that would kind of be silly. You may as well go after the longer end of the market because that's where you're going to have your greatest impact. But the market's testing them. The market is doing exactly what it's supposed to be doing, testing the Fed. And the Fed won't acknowledge it. Now, my question is, and now I've read John Authers and Yellen's out there talking about that the percentage of the budget, federal budget, relegated to the interest cost on the debt is almost at all-time lows, even as the debt blows up, because interest rates are so low. But and that's why they're not worried. They do it as a percentage of the entire budget.
If they're close to all-time lows, when were the all-time lows?
Well, listen, under Bill Clinton, we ran surpluses.
Yeah.
So we're looking at this, and yet we know what's coming, right? We just had $1.9 trillion more. Yes. And they're doing their borrowing. See, that's why there's so much pressure on the short end of the curve, which is driving a lot of money market funds crazy because they can't get out from under this. Because the Fed keeps borrowing, the Treasury, I'm sorry, not the Fed, the Treasury keeps borrowing short term because rates are pegged at 0. 8 basis points. Well, when the market says enough, and it's enough, which is why they're taking the free run. Okay, you want to play this game? Okay, here you go. And we're gonna come and we're gonna make your life miserable. And Powell is convinced, no, I'm gonna sit here. It doesn't mean anything. Inflation's under control. He believes that investors will eventually come back and start buying the long end. He doesn't have to worry about it. I mean, that's what he doesn't say. If you got another answer, tell me. But I try to look through this logically, and I'm stuck.
No, it makes absolutely no sense to me. It just absolutely, I have no idea how to make heads or tails of it. I don't know what to do with the equities as a result of it either, except for just trade it, trade the range and wait for a breakout.
Exactly. And I'll tell you what, and I know Judd has done this really well. The SPU bond is really interesting. And I keep coming back to it because we saw that big swing. So maybe that spread has to go to 2,800.
Yeah.
To give you that symmetry of that big, if you're that type of technician who looks at swing counts.
I do.
Keep looking at that. Maybe, and you know what? When the steepening curves are always positive in the immediate 6-month period for equity markets, just like they're bad for a currency. Now the market wants to rally every time the 30-year or 10-year goes higher. It wants to, yields are higher in the US. And right now, the algos are having their way. But I'm telling you, historically, that's not what happens based on market fundamentals. But this one may truly be different. And I have to acknowledge that.
Huh.
I have to acknowledge that. So I'm looking for currency spreads to play. And I'm watching this euro yen very close. It's at the 200-month moving average. It's playing with this number. It knows this number. The 200-month moving averages have been really good, by the way, of late.
It's been near the 200 month, hasn't it, for a while, a couple weeks?
Yeah, it's the 200-month. The cross right now is 130.13 in real terms in cash prices, and the 200-month is 130.30 basically.
Mm-hmm.
It knows it, and I love these mean reversions, and this is a big mean reversion, but this is a huge cross in the world of because it reflects a lot of things. Now, this may blow through here. It's hard to believe it because there's nothing good in Europe right now. And I am bearish the dollar, but I'm cautious here because rates are going up and I have to see the way this plays out. Mm-hmm. And yesterday, as I'm listening to Powell, the euro had a huge rally. It almost rallied 1%, and I'm going, well, that's not the one currency I'd be buying. So I've been bullish to Canada, and I've used Canada as my spread vehicle because if you think that the US is that great, fine. And Canada is going to come with it. And the 10-year in Canada is only 8 basis points less than the US. And they're doing some stupid things, but they're not doing as stupid as the US where they're throwing everything against the wall and seeing what sticks. And the US is out over its skis politically on the international situation. Mm-hmm. China and the US are going to be at loggerheads here for a while. You can't keep threatening the Chinese and expect them not to respond. All right, I'll take one more question, and then I'll come back later if you want. I just have to do the get ready for podcast.
Yeah, that'd be great. Let me ask you. So let's go back to the SPU bond real quick. Can you, Shelly Manafee is one of the more experienced traders in our group. She's a woman from Texas, a great trader too. And she'd asked me about, some things of something to read or, to go to learn about the bonds. Can you give us a brief history on how you came up with the SPU bond spread and what you're looking, what you use the spread for, what you and Judd use the spread for?
Well, let me tell you, I came up with it. I mean, sure. But I was thinking about it because I was just really trying to understand. This is probably 1988, 89. And I was out for a run because I never
along the lake.
Yeah, on the lake. And I called Howard from North Avenue Beach. There was the telephone was, I said, I can run this work. I said, it's hitting me because I didn't believe that equities could just exist in the ether world, untethered to anything. I said it has to have some relative value. And looking at it, he came up, he said, wow, this relationship is far greater. And it took him quite a while. He did a lot of work on it, as he always does, because his work ethic was unbelievable. He says, there's a lot of relationship here. And that's really, and then you see a lot of people, they don't necessarily say the 30-year, they may use the 10-year, but they do tie equity values to interest rates. Now, in a zero interest rate world, you may say, that's why he keeps pushing. And it's really, what will there be a break level? Yeah, I promise you, if inflation is 2.5% and the 30-year is 4.5% yield, which is basically historically what you got, was right. What you want to look at. Shelley, go look and examine the real yield on that long end. It's almost what Schiller does with his cape. He's cyclically adjusted for inflation, but you're really talking about what's the historic real yield? What's the historic real return on money in the US? And you can measure it to that. That's a far better measure. Because again, we have never been here. We have never seen this. Where we've been pegged to zero with inflation, even by the Fed standard at 1.6, 1.7. but interest rates are zero. That's a negative real yield of 170 basis points. Let me again explain something to you. Let's build our own theoretical model here. You have $1 million to put in the bank, or you have $1 million. It just fell out of the sky. You inherited, somebody called you, you have a long lost, left you $1 million. If you put that in the bank in a 1-year CD, what do you think you're going to get? Oh, are you going to be surprised to find that you're going to get $3,000? Is that going to really stimulate you to act? And that's where the world in which we live in. So now go make a decision. Go make a decision how you want to invest that $1 million. And then look to see where the stock market valuations are. Now, what am I chasing here? Am I really comfortable? Now build a portfolio. And that's how you should really start to look at things. How would I build a portfolio if I had $1 million to invest? And in there, I measure historic rates of real rates of return, because that's a really important issue for me. Always has been and always will be, by the way. I just, because that's what money is about. You stop thinking in terms of hysteria and emotion and start looking to see what money is supposed to be about. And it's supposed to be a medium of exchange and a store of value. Okay, now you're putting things together to work. Find a store of value that makes you comfortable. Matt, as we built that portfolio out, and I have to say it was really, starting from last April and May, building out things that we were buying, ags, even banks, we had some banks that we did like, mining companies. It's been a really good play. I mean, we've had Freeport, which has gone from when we started talking about it and investing in it, $8, $9 all the way up to, where's it trading today? $36.74 as we speak. That's a mining company, a state mining company, but there was thought and reasoning behind it in that environment. So that was comfortable. And as I said, it's not Peloton, it's not Amazon, it's not Facebook, but it allows you to sleep at night. And you know what? You can sleep pretty well. And that's, in this environment, what I'm looking for. So I'm going to end there because I got stuff to do. And then, but if you want, send me, I'll be freed up in about 2 hours.
All right. I'll text you or email you.
I mean, this is good. Shelley, good questions, but always look and then measure it in terms of what real yields. And I promise you, if the real yield on 30-year money, if they were able to push rates so high, that would have the effect. And there's a lag effect to it. But as long as money is treated with real returns that are mostly negative, except out to, let's say, 20 years in the US. In Europe, they're all negative by far. But in the US, and if those go positive, I don't know how long it'll take, and it'll depend how positive those real returns go, but it will negatively affect the equity market. There's just a lag effect to it. And I can't tell you exactly. I have the study here. Aaron Perzoff. I interned for 2 years. Here's the study. An investigation of the relationship between changes in yield curve and the performance of stock indices.
Can you hold it up?
July 21st, 2004. Erin was phenomenal. Her father, I mean, she's really so bright. She gets it. I've had great interns. And she just was a star. I knew she'd always be a star. She's a rising star at Morgan Stanley in a really good area. She's got great integrity. She's great. But we looked at this. She interned for me for 2 years. At the same time, she was writing her undergraduate thesis under Rogoff on currency values and emerging markets. She went
Jeez.
she went from Niles West to Harvard, and not because anybody paved the way for her. She just,
She made it on her own.
and a real person, softball player, clarinet. I mean, she's great and fun. Really, but I mean, we've looked at this, and that doesn't mean it's just a study she did when she worked for me. You know, she says, give me a task to work on for this. This was the second summer. Let's look at this. Has always bothered me. So it's interesting. Now we're going to look at, and Shelley, you got work to do. Go trace the history of real yields. Look at it on the 10-year in the US, because you'll get a sense of where we're at. And again, perspective.
That's exactly what it's about. Perspective, context.
Shelley, you could probably find that if you go to the St. Louis Fed, but in today's Google world, and then share it with us, because again, it's the interchange, and see what you find.
Hey, Ira,
Yes.
one last thing before you go. Was Jack sick, or did he just did he have a stroke and then he went, or did he have a stroke a while ago?
I just, I was sitting with Terry on Thursday and Mike Dennis, and just, discussing a few things, and it was really a nice conversation. And Terry told me Jack had a stroke. I didn't know it, and then the next day he died. So
it was new. It wasn't.
I had actually talked to Matty Eggers, who had seen him, and said, Jack had a little fragility.
Oh, I didn't know that.
Don't forget, he was a Golden Gloves boxer.
Yeah, tough guy.
Take their toll. I don't know. I'm not his doctor, and Jack and I were always cordial and friendly. Even when I disagreed with him quite a bit, as I did. By the time I got on the board, though, we got on the board only because things had become shaky at the exchange, and we needed a change.
Matt Eggers is a good guy.
Oh, yeah. As I was moving, I have really good old electronic equipment because I have an in-house stereo system. Twice I revamped it, so I had the equipment, and I know Matt loves that stuff. So I sent him a note. I said, come on over. It's yours. I know it, just take it away. I'm busy getting rid of stuff. So
No, it's great.
He came by and we talked for quite a while. So
if you talk to Terry again, tell him I said hello.
I will, and I will. Again, because I'm running, and I always like to touch base with him so he knows what I'm about. So it's very good. And I had never met Mike Dennis, but I'll tell you, I was very impressed. And he runs ABN, and ABN is such a power in the omnibus account business and clearing so much of I go back to the old ABN of the people I knew.
Yeah, no doubt.
So
all right. Hey, thanks for spending the time with us before your podcast with Macaulay.
Hey, we're putting Shelley to work. It's well worth my while.
What?
It's well worth my while.
Oh, sure.
And Shelley's a woman, I take.
She is, yeah.
Okay, because I know Sheldons who get called Shelby, but I assumed that Shelley was a woman and a Texas woman, and we don't mess with Texas, right?
Oh, she's stronger than I am. She's stronger than I am. I'm afraid of her. She's also smarter than I am and a better trader than any. Most.
Good question. Good question. So yes, you know what? But that doesn't surprise. Listen. I think. I thank you. So okay. Well, but if you send me a Zoom later,
I will.
I'll get back to you.
All right. Thanks, Ira. Have a good one.
Okay. Thanks.
That was great. Thank you.